Hi, I'm Tom Mihawk, and this is the second segment of 3 in the Investment Fundamentals chapter as part of a personal finance course available with all these chapters. And we're going to talk now about calculating a return. This is a very simple thing to do. It looks complicated from this formula, but think of just 1 year. And if your ending value of an investment was, say, $100 and the beginning value was 50, you bought it for 50, you sold it at 100, it would only be to the 1/1 power, or it would just be 100/50. And I'm just using my calculator here. And so I would just take 100 and divide by 50. I get 2. And subtract 1. And I get 100% return. Correspondingly, if I had a year and I bought something for $30 and I sold for 35, 30 divided by 30, and take 1 from it, that's a 17% return. There we go. So this is a very simple way to calculate, and it just gives you, the exponent just gives you a way to do this with some accuracy. It's still not as if you'd calculated it with a calculator, but it gives you some accuracy for multiple years. If you also received dividends, you'd add the dividends into the numerator. So you'd have the amount that you sold for, you'd have the dividends, and then over the original investment, and to the exponent of 1 over the number of years, minus 1. A simple way to do this, if it's just in 1 year, is just take the value you received in total at the end of the year, or when you sold, divide by what you purchased for, and subtract 1 from it. Sources of returns, capital gains. This is an important term. It's a tax term, but it's an investing term too, and it means the difference between what you sold a security for and what you purchased it for. The difference between, and in tax we would call what you purchased for the tax basis, and what you sold, the sales price or the sale proceeds. But it's the difference between what you purchased a security for and what you sold it for, or the value of it now versus its purchase price. Dividends and income are received. Dividends from stocks distributed annually by companies. Income you might receive, or interest from bonds, for example. Interest is our bottom bullet here. Received from cash assets at a financial institution. Income you might receive from bonds. And the dividend, it's interesting. Who pays dividends? New companies or old? Big ones or small? Well, bigger companies that are older. A dividend is a way for corporations to provide an incentive for people to own the stock. And if the stock is not likely to go up rapidly in price, a dividend is an additional way for the company to get interest in the stock and get people to purchase it. Think of older companies, Procter & Gamble, General Motors, GE. Older today might even be Microsoft. I remember when Microsoft first started paying dividends, and that seemed like a watershed moment. So older, larger companies pay dividends. These are your sources of returns: capital gains, dividends and income, and interest. Liquidity. Liquidity is very important. It's a term that describes how quickly an asset can be turned into cash. Obviously, paper money and coins are, by definition, the most liquid. They are liquidity. We would call those collectively cash, as we would potentially bank savings accounts and money market accounts. Collectively, they're called cash too, but real cash in public description would be paper money and coins. Marketable securities are liquid. You can sell a stock. Maybe we're now, as of this recording, in the middle of the coronavirus hitting us and planning for it. And so maybe things aren't that liquid right now, although you're still able to sell securities in the market. Many people are, which is why prices are going down in the stock markets right now. But marketable securities are fairly liquid. Homes and investments in private equity, for example, are illiquid. Can you sell a home in a week? Sure. Would you want to? No. So if you need to sell a home in a few days or a week, someone may offer you half price or 40% off. And that may be incentive enough, if you really wanted to sell it in a few days or a week, to do it. Best is to allow a home a chance to have a buyer come that's willing to pay a fair price. So paper money and coins, the most liquid. Marketable securities, liquid. Homes, private equity, things like that, illiquid. In general, you pay for liquidity. What that means is the more liquid an investment is, the lower your likely return is. You pay for liquidity. And liquidity is valuable. That's why you pay for it. You need liquidity. For example, you need liquidity to pay your bills. A high net worth person with lots of assets and low liabilities who has very little liquid assets can't pay their bills any more than a low net worth person can. So liquidity is very important. You've seen investment funds that had to meet cash, capital calls in their private equity investments, and if they don't have the liquidity to do it, they have to sell securities. And if they have to sell securities in a bad market, they sell at a loss, which locks in a bad return. So liquidity is very important, and you tend to pay for liquidity. Now, this is the same chart you saw a little while ago, except this one describes the annualized returns of these securities. Asset classes are groups of securities that behave similarly in the market. Stocks, look at that line, the top line for stocks. It's more jagged than the others. Obviously, it goes higher than the others. I said before that between 1802 and it looks like 2006, stocks started out at $1 and became $705,000 over that time frame. Well, that's a 6.6% annualized return. By comparison, bonds that started at $1 by 2006 made it to $1,778. That's a 3.6% return. Stocks, the way they behave is they have greater volatility and higher return expectations. In the short term, they may not exceed other asset classes. Notice in, 1980, 81, notice in 99, 2000, 2001, notice in 1931, 32, stocks went down greatly, much more than bonds and bills did. So an asset class is a group of securities that behave similarly. They often have similar regulatory treatment, similar legal and tax treatment, but for an investment standpoint, the key thing is to know that they behave similarly. They have similar return expectations, similar volatility expectations, and those sorts of things. Let's come up with some ways to measure and describe returns of our investments. Beta. Beta is a measure of one security's volatility relative to another. If these two securities, if one goes down, the other one goes down. One goes up, the other one goes up. That's a beta of 1. If this one goes down and this one goes up by the same amount, that's a beta of -1. Or to the point in the bullet, if this one goes up 1 and this one goes down 2, that's a beta of -2. Moves twice the amount. It's like in engineering or the sciences, we would call that a vector. It has both direction and magnitude. In the classroom, I put students in a line, and I start with just 2. Put students in a line to imitate a portfolio, but I start with just 2. And I put them together, and I have one move, reacting, making up their own movements. And then I tell this one to be a security, and I say, be a beta of 1, and so they move like this. If they're a beta of 2, market's up 1, they're up 2. Market's down 1, they're down 2. And from that, we then go into building a portfolio, which has multiple asset classes, all of which move in different amounts relative to the market or some other index, and mimics the way a portfolio works, such that the average return hopefully is less down than the market is down in bad markets. Unfortunately, maybe less up than the market in up markets, but you get a dampened but less volatile and maybe more predictable return. Alpha is return in excess of expected or excess of the market return. There's a wonderful blog that I read called Abnormal Returns. It describes the amount of return that's in excess of what was expected. And alpha is valuable. Beta is, you can get beta by investing in the market generally. You move with the market. But alpha is when returns exceed the market. And if you can get a return that exceeds the market with volatility less than the market too, that's like the holy grail. You would pay more for alpha. Passive or index investing uses this beta measure to imitate the market. It's a portfolio comprised of a list of securities, often brand named like the Standard & Poor's 500. No effort is made to beat the market or the benchmark return. Passive or active portfolios should be low cost. You are getting the market return. You're not trying to buy and sell securities to beat the market. You're trying to get the market return. And it might not just be the S&P 500. It might be the NASDAQ, or it might be the Wilshire 4000, or it might be the FTSE, or a South American or Southeast Asian index. So there are a variety of returns. And lastly, active investing. Active investing is where you try to beat the market. I use this example. It's not completely true. It's exaggerated, but I use this example. The passive index fund manager comes in, checks the coffee in the morning at 8:30. 8:45, they check and make sure the portfolio is doing well. By 9, they left and gone to the golf course. The active manager gets up at 5, checks in with how Europe is doing, reads on the train on the way to the office, makes decisions all day long, buying and selling securities, leaves, reads more research, calls Asia, find out what they're doing at the end of the day. This is an exaggeration. It's not true, but it's a good way of thinking about how the two kinds of investing work. Passive or index investing has taken the world by storm the last 5, 8 years, maybe 10. And the idea is that for the average investor, even David Swensen, well-known investor, runs the Yale Endowment, says for the average person in highly traded, like large cap, and we're going to talk about that in a minute, large cap portfolios, where information flow is broad and widespread, the average person is better off with an index portfolio with low costs, such that their net return is better on average. Active investors do well, they just don't do well consistently for the average person. Maybe professionals find them, but the average person, it's very difficult to find active managers that beat the market consistently. Some common investments that you'll look at: stocks or equity is proportional ownership of companies. We pretty much know those well, I think. Bonds are loans you make to an issuer who promises you interest and to pay you back the principal in the future, 5 years, 10 years, 30 years. Mutual funds or exchange-traded funds are diverse, professionally managed portfolios of similar securities. Real estate, direct investment might be like your home or properties you own that you rent. Indirect investments might be in syndicates or limited partnerships where you pool your assets with other real estate investors. They can be residential or commercial. They can have geographic variety. There are a variety of ways to invest in real estate. Alternatives consist of private equity, venture capital, collections, and options, for example. And others might be commodities, metals like gold, silver, titanium, art, collections. I just put this in for fun. Sports teams. So there are lots of kinds of investments. We're going to talk about all of these in later chapters and in more detail. This is the end of the second segment for the investment fundamentals section.